Hello and a warm welcome to Invest Africa. I'm Bronwyn Nielsen. Over the coming weeks, we'll be taking an in-depth look at the challenges and opportunities associated with investing in Africa. We'll be travelling up and down the continent, getting insight into various economic territories across Africa. In a world that is looking for alternative investment destinations, Africa is seen as the next investment and growth frontier. However, in order for the continent to secure its place in the global economy, properly developed infrastructure that can support business development across the continent needs to be established. Let's take a look.
Africa is well positioned as an emerging market and is a wealth of opportunity for investment and growth. The world is eager to do business with Africa, however, finds it difficult to access the African market, especially in the interior, primarily due to poor infrastructure. Although the continent has successfully maintained an average growth rate between 4 to 6% in the past few years, Africa accounts for 12% of the world population, but only generates 1% of global GDP and only 2% of world trade.
The individual country borders into some of the big regional integration programs that are on the cards, like SADC, COMESA, East African Community, then we see that the numbers are there to support the scale. 600 to 700 million people, $1 trillion combined GDP, literally from Cape to Cairo, a large area as well. And I think that this is a base that we can build on.
Energy supply continues to be Africa's largest infrastructure challenge, with 30 countries experiencing frequent power shortages, and with only just over a third of Africa's population with access to electricity. Electricity supply is among some of the business opportunities that can power Africa's growth. In a recent study, it was shown that the poor state of infrastructure across all sectors reduces national economic growth by 2 percentage points each year and cuts business productivity by as much as 40%. The high costs of business have had a ripple effect on businesses and consumers alike.
There's definitely benefits for trade in the continent in terms of especially freight rails, various plans to grow its rail infrastructure in the coming years. So those were very welcome commitments. Those have been a source of complaint and concern of our members for a long time, that we are inefficient in moving goods to our harbors and getting them to the rest of the world. So it doesn't help Africa in particular right now, but they're definitely going to be spin-offs.
Although investing in infrastructure is paramount, approving the right type of infrastructure at the right time is just as crucial to a continent's continued economic development. But these capital outlays do come with a price tag. According to the World Bank, $90 billion is needed in order to fund infrastructure for the next 10 years. $60 billion will go to new projects and $30 will go to the maintenance of the existing ones. However, only $25 billion has been allocated for these capital outlays. With Africa having received its largest share of global foreign direct investment to date in 2011, this may very well help fill the financing gap.
Now joining me in studio to give us their thoughts on infrastructure in Africa, Emile du Toit, Head of Infrastructure Investments, Harith Partners, Paul Runga, the Managing Director, Africa Project Access, and Brian Blake, Vice Chairman, Marsh Africa, and of course joining us from our bureau in Nairobi is Gabriel Negatu. He's Regional Director of the AFDB's Eastern Africa Resource Centre. Gentlemen, thank you very much for your time. How are we going to close? Let's start with this coming out of that introduction. How are we going to close the infrastructure gap, that much talked about infrastructure gap that could in fact increase economic growth across the continent by some 2%?
Thanks, Bronwyn. I think the gap is quite big, clearly, and a lot of investments required. I think investment from all parties, both public and private, is required. And that's one of the things that we're seeing, is that governments are realizing more and more that they can't fund this off their own balance sheets. And we're seeing increasingly use of PPP models. And that's really the space that a fund like ourselves also look at investing in. So it's essentially necessary for both private and public sector to invest. And for example, one of the areas where we source our funding from is from local pension funds. And I think what you need to see going forward as well is more African pension funds investing into Africa, as opposed to taking their investment money and buying US bonds and things like that.
Paul, do you think that's a reality? We are going to see more African pension funds investing in Africa?
There will be the need to mobilize local finance is a very big issue. And within the project finance space, the number of players now in this market has increased considerably. We're talking about way off, it's not business as usual anymore. We're talking about operators funding their own projects. For example, Vale and Zambezi Valley. They are part of the Nakala Development Corridor Group. So much of what's going on is resource driven in the end. And the infrastructure has to support the resources and evacuate and export the coal, for example, from Zambezi, from Botswana, etc., etc. So it's created a very strong impetus for support infrastructure development at the moment. And I think what's happening now with support with finance for projects is that the sources of the finance have widened considerably. So, for example, operator finance. But there's sovereign wealth funds, there's equity funds, there's numerous equity funds that are appearing all the time.
There's no doubt it is a hotspot for investment. Brian, let's get your thoughts on this.
Well, I think from my point of view, and this is slightly self-interested here, our view is that you need to make the lenders more comfortable. You know, a PPP can last in excess of 25 years. The finance for the project is at risk from day one, from the start of the project. And our work essentially looks at how to identify, how to mitigate, how to transfer the risk associated with the projects. And if you look at projects north of South Africa, you have certain generic risk associated with political issues, regime change, convertibility of currency, ability to remit funds abroad, the security that protects the financing around the asset. So a lot of our work really is around the whole life cycle of the risk, from the conception of the project through until the execution and maintenance and operation and beyond. And then look at it from the point of view of the different parties in that structure, whether it's the lenders, whether it's the construction companies, whether it's the professional surveyors or engineers. Everyone is going to cost that risk, the finance risk.
Gabriel, perhaps we just pick up on what Brian has said there. It's about making the lenders more comfortable. Do you think that is the reality? Is that what is happening on the ground?
Well, absolutely. I agree with the previous presenter. The need to make the lender more comfortable is indeed an issue, and this borders on the issue of governance, on the issues of capacity. And we at the African Development Bank, in addition to the financing we provide, do work with government to help them set up the appropriate regulatory and policy framework to encourage PPPs, to encourage greater governance, transparency and accountability, again, to give comfort to would-be investors to come and join the public sector in financing infrastructure.
Emile, do the risks outweigh the rewards still to this point?
Thanks, Bronwyn. Yes, I think there's a fair balance to be had. Essentially, what we're seeing is that that in order to mitigate all these risks, as Brian has clearly said, it's quite complicated, and that all adds to the cost of the project. And so project financing costs in Africa clearly is quite high, much higher than you would find in more developed areas. As an example, you would need to have lawyers coming in from different areas. Also, just the logistical problem around that does increase the cost. And so the question is always, for the perceived higher risk, you're supposed to get a higher return. But I think the project costs and the additional project cost that's added by the structuring reduces that. So, in some cases it's difficult to get that, and that's really where the private sector gets involved at trying to pick the projects where the risk reward does make sense, and the ones where it doesn't, maybe engage further with DFRs or local governments to try and improve that situation.
Can I just put a twist on this a little bit? We're talking a lot about the government, the regulatory environment, and that is very important, no doubt. But talking more from the actual operator's side, where I come from, I'm more involved with project identification, and I work a lot with individual companies and contractors and so on. There is a huge need at the moment for companies to react in the right ways in order to mitigate risk and so on. One thing is to develop consortia that make sense. And that is happening. There's more and more collaboration cross-border as well. I mean, cross-nationality consortia building that is happening, and it is assisting. But the other thing that is very frustrating is that certainly in the case of South African companies, I realize we're not just wearing a South African hat here by any means, but as South Africa is perceived as a major player, the lack of utilization of the financial instruments that they have at their disposal is a big problem. South Africa has the Development Bank of Southern Africa, has the Industrial Development Corporation, has the Export Credit Insurance Corporation. If you do a survey of many of the players, they are not, I'm generalizing.
So you're saying that the financial institutions are there, but people aren't using them?
Exactly. Certainly in the South African case. Of course, I'm generalizing. There are people who are using them. But I would say that, for example, the Capital Project Feasibility Fund is one of the instruments offered, products offered by the Department of Trade and Industry, yet its utilization is very poor. And if you do a survey, you'll find that very few people are aware of this. So there's a bit of a disconnect between the operators and the financial people.
What do you think about that, Gabriel? Is there a disconnect between the operators and the financial institutions or the financial instruments available out there?
I'm not sure I have the data on South African firms in particular, but for the African Development Bank, the resources that we have made available are utilized quite extensively. And of course, you have to bear in mind that we ourselves directly finance infrastructure projects through the public sector, both through loans and grants. And then we have the private sector window, which syndicates loans to private operators and makes available resources. And so far, we have not had much difficulty finding takers. But as the colleague said, we've got DBSA in South Africa, and then the other institutions. There may not be as many takers as I would have otherwise guessed.
Brian, let's get your thoughts on this.
You know, we've seen over the... I've actually been in Africa now for about 30 years, and it's interesting the way that these projects have been viewed and developed over the years. I believe in the past they've been very hit and miss, and in some of the projects I've seen they were more miss than hit. Certainly I remember when I first went to Nigeria, there were great plans for a railway going around Lagos, a high-speed railway going around Lagos. Now, if anyone's ever been around Lagos, you know that high speed actually can mean anything above 5 kilometers an hour. But this thing was ill-conceived, ill-planned, and there was, as we just said, a lack of governance, a lack of control. It wasn't just Nigeria. These things happened everywhere, and you found a lot of the financing disappeared before it actually got anywhere near the project. I think that going forward now, there's more certainty around the way that financing is being done and the vehicles that are being used for the financing. You know, PPP is a generic term that tends to be used for any public-private partnership. But I think that we just need to, there needs to be an encouragement of the participation of the different sorts of finance available in the different projects that are coming on.
We're going to a quick commercial break. More on Invest Africa when we return. Stay tuned. Welcome back to Invest Africa. According to one of the big four tax and advisory firms, investor perceptions have improved, which has led to an increase of FDI into Africa. The continent can now leverage on this source of funding to further power its economic growth through infrastructure development. Again, let's take a look.
Africa captured 5.5% of global FDI in 2011, which increased from 4.5% from the year before. The continent also saw a 27% increase in FDI projects for the same period.
So from the developing country perspective, I think we've seen them follow their own market needs to look for resources for their home markets. At the same time, we've also seen the more middle-income countries looking to their strengths in terms of coming to Africa with their own businesses. And from India, it's really been around services. India has a strong entrepreneurial class that is bringing services to Africa, whether it's IT services, renewable energy. At the same time, from China, their strong point has been manufacturing, and their manufacturing costs are growing in China, so they're bringing their manufacturing companies to Africa, where they can reach similar standards at the same time at lower costs. So I think these are the type of investors that we're starting to see in Africa.
Despite the European economic downturn, investments from both developed and emerging markets still followed an upward trajectory, with projects from India, China, and Turkey in the lead. One of the projects that Africa saw was the turnkey agreement between JSE-listed company, Sipaku Holdings, and Sonoma, International Engineering Company of Beijing, for the establishment of one of Africa's largest cement manufacturing plant.
It's been a long time coming. We've been working on the project for 5 years now, and we're very excited that we're getting out of the ground. It took us a long time to get the financial package together, but we managed to do that at the beginning of last year, and serious construction finally started at the beginning of this year. We're going to be in cement production by August 2013. I think what also makes it special is a lot of European suppliers of mechanical equipment.
According to Ernst & Young, Africa is still lagging behind India and China, and investor perceptions are one of the contributing factors. And although it has improved considerably over the years, factors such as corruption and an unstable political environment rank high on the list that could deter investors.
Their ability to have regulation that is consistent and transparent. So I think this is something, IFC has been working with the African governments across the continent to try to improve the legislation around the private sector and around the standards needed to grow a vibrant and sustainable private sector.
It is recognized that infrastructure is a catalyst for economic growth and can pave the road to greater regional integration. And with the continent anticipating further capital inflows, Africa can realize its full growth potential. Dumisha Machanyele, Johannesburg.
Still with me in studio, Emile du Toit, Head of Infrastructure Investments, Harith Partners, Paul Runga, the Managing Director, Africa Project Access, Brian Blake, Vice Chairman, Marsh Africa, and from our bureau in Nairobi, Gabriel Negatu, he's Regional Director of the AFDB's Eastern Africa Resource Centre. Gabriel, let's throw it to you. We had the South African President Jacob Zuma saying recently that Africans have got to stop being pessimistic about the continent and that we have to become leading ambassadors. What are your thoughts on that statement?
Well, I think I'll have to agree, absolutely agree with that. But optimistic we should be, but guardedly optimistic. There are many things that are going in the right direction. I think Africa is on the move. I know the East Africa region is a robust region on the move. However, we also have to be mindful of the some of the setbacks that the continent continues to suffer from time to time, most recently in Mali, and of course Somalia remains a scar on the continent. So what this needs is really guarded optimism, but certainly we should stop being pessimistic and be very optimistic. The resource demand for Africa's resources is high. Africa is a great investment destination. Governance is looking positive. The economic productivity, performance, growth, they're all pointing in the right direction. So I will have to be very optimistic and share that sentiment also.
Brian, I want to bring in austerity measures in Europe and in other territories within the developed environment. How is that going to impact the Africa story? Are we going to see ourselves at more of a disadvantage when it comes to trying to close that infrastructure gap we spoke about in the beginning?
I mean, personally, I think that it's an opportunity. I think that certainly as a company, we're seeing the opportunities presently in Africa rather than Europe, rather than North America. If you look at the projected growth rate in Africa, it's where the opportunities have to be. Now, it's always been the case in Africa that the greater the opportunity, the greater the challenge. And we've seen that in a number of countries. But if you look at the resources available, if you look at the need to have this infrastructure program implemented, Africa has to be a glass half full, in my view.
Rather than a glass half empty, that is, of course. So let's look now. We're using this term infrastructure relatively broadly. What are we talking about here? Is it roads? Is it railway? Is it really about transports and logistics? Is it power stations? Is it dams? Is it across the board? When you look at infrastructure, how do you break it down?
Well, as we're monitoring projects all the time, I can tell you it's across the board, most definitely. But there's certain emphases, like for example in ICT telecommunications, it's been lower hanging fruit. And there's been much more activity in that area, as we all know. And when you get to a difficult sector like rail, which is very high capital amounts required, it is difficult. But that being said, at the moment, the evacuation and the export of the commodities, as I mentioned earlier on, rail is the only way to go. You can't do it by road truck. You just have to do the rail. So rail is at long last getting its place in the sun. Power is generic to everything. It's, as you said earlier yourself, Bronwyn, that's the key issue. I just want to say quickly something about the European story. I've just come back from Germany and Austria, where we were addressing subject of risk in Africa, and the rooms were full, absolutely full. The situation is globalized so much now that, and also in connection with the previous discussion about vote of confidence in Africa, Africans are voting with their money in Africa. Oando, Dangote, these are two Nigerian players, but the others too that are actually, so we're seeing everybody involved now, not just your former colonial countries, but now China, Russia, but also Turkey, and it's an enormous range of people playing.
And of course, Africa coming up with its own success stories, as mentioned there by Paul Dangote, is worth $13.3 billion US, outranking by far Oprah Winfrey and even our very own Patrice Motsepe. I thought I'd just throw in a bit of trivia there for you. Emile, in terms of what you're seeing, the hotspots, so if you were to break down infrastructure, what would that be?
If I look at our investment pipeline, the majority of this stage is still on the power side, both renewable as well as thermal power. Mostly generation, but also some distribution businesses. And then, that's almost 50% of our pipeline. And then the rest of it is mostly taken up by transport. And then a little bit on the telecom side as well, more on the broadband, telecoms, etc. But really the areas that we see the biggest investment opportunities are power and transport. On the transport side, both ports, airports, road and rail. And then, as I said, the power side, that is all across. We see smaller hydro projects in let's say, more risky countries and smaller countries. And then you see some of the larger projects in Nigeria, even the Nigerian privatization currently happening in its power sector. So we're seeing both on the west and the eastern side a lot of opportunities on power and transport.
Gabriel, your hotspots in terms of focal areas where the African Development Bank is concerned?
Well, for us, I think it will have to be power and transport. I think in power, both in terms of generation and distribution, we see a lot of opportunities and potential. Most of the countries in the East Africa region have recently come up with all kinds of minerals from Tanzania to Uganda to Kenya and South Sudan and possibly Ethiopia coming up. So power will remain a big issue. Next is transport. The multinational transport projects that we're doing, Ethiopia, Kenya, Tanzania, Kenya, Uganda, Rwanda, Burundi, these are and then the connection with the DRC. These are the great enablers that will facilitate regional integration, which is one of our top priorities. So we see the transport sector as being a key. And then railways. We've got this big project coming up, Dar es Salaam, Isaka to Musongati and Kigali. Again, a very high capital intensive project. We've just done the East Africa Railway from Mombasa to Kampala. So transport next to energy will be a big one.
What about the Cape to Cairo project? Are we seeing that coming to fruition? Much was made of the project at the World Economic Forum. We know that it is set to link 598 million people, 26 countries. Gabriel, just your thoughts on this project?
Well, we've just given a award for the Ethiopia-Kenya connection, which in effect now enables a businessman from Cairo to drive all the way down to Cape Town. So this will be the last leg of that connection, and it will certainly facilitate regional integration in the COMESA region. So yes, we are very much making that happen.
Intra-Africa trade, now currently sitting at around 10%. If we close that infrastructure gap that I alluded to earlier in the conversation, apparently we can double intra-Africa trade. Does that sound like a realistic goal?
I think so, provided that all things are equal. And two of the things that have been said in terms of prioritisation of infrastructure, I was also going to say, which is power and which is rail. Not just transport. If you look at the state of a lot of the African roads, we do need an effective rail system, and you can't have an economy without adequate power. We've seen that ourselves. So, and the power projects, the hydro projects that are in place at the moment would facilitate that, and then you can export the power, which is part of the inter-regional trade as well.
Gentlemen, thanks so much for your time. We've come to the end of this week's edition of Invest Africa. We'll be back again at the same time next week. Until then, from me, Bronwyn Nielsen, and my guests, it's goodbye.